example, preparation of balance sheet, preparation of income statement for the external shareholders, such as investors, regulatories, authorities, management accounting. On the other hand, is intent for the internal use. So, financial accounting deals with the preparation of financial statements, and it is very useful for the external users. Whereas cost accounting is subset of management accounting that deals with this specifically with analyzing production cost to enhance control and efficiency. So this means what? These both are different. Financial accounting focus on the preparation of financial report, and based on the past data, recorded data, we are going to prepare the. And cost accounting is a subset of management accounting that deals with this specifically within the analyzing production cost to enhance cost control and efficiency, while cost accounting focus on the cost reduction and budgeting management. Accounting use this data to assist the broader decision making. What is the scope of management accounting? Management accounting covers the financial and non-financial data, whereas financial accounting covers only financial data. Second one is the helps in decision making, planning and control. So management accounting, it will help to decision making, and it will be involved in planning and controlling and future oriented, flexible. So these situations, management accounting, we are going to use. And what is the objectives of management accounting? See, objectives, generally there are many objectives are there. Yesterday also I discussed about the objectives. Generally, it is going to be forecast, it is going to use cost reduction, cost control, utilizing the resources, funds allocation, fund utilization. So different objectives are there. Among that all the objectives, some of the important objectives I mentioned here. First of all, profit maximization. Second one, cost control. Third one, effective decision making. Fourth one, strategic planning. What is the profit maximization? So management accounting look into utilization of all the resources. Thus resources also includes cost of elements like material, labor, and other expenses. So that all they are going to use, and maximum productivity they try to give, and giving of maximum productivity, they try to maximize their profits. Cost control. Cost control means what? Every organization, there are different activities are there, different departments are there. Among all the activities, sometimes they are going to waste the resources, as well as they are going to waste the materials, labor hours, and other things. So to avoid that wastage, to minimize the wastage, they are going to implement the cost control technique. And management accounting also, they are going to take the effective decision making. See, the installation of plant, for example, the spending of amount on capital expenditure, the spending of revenue expenditure, the expand of production. So these are all the situations. They are going to take the very effective decision. And also among the competition, they are going to take the proper planning for the facing the competition. So this management accounting, they are going to involve in strategic planning also. So these are the objectives. And management accounting process. Generally, management accounting, they are going to follow some process. First, they are going to collect the data. After collection of data, they are going to process. After processing the data, They will give the interpretation. After interpretation, they are going to communicate to the management. After that, they will take the decision making. See, if you observe here, first three steps, these same steps are involved in the accounting also. So first, what we are doing in management accounting process, we are collecting the data. So data also we are going to collect from the internal departments only. So internal workers, whatever they'll give, internal management, whatever the data will give, that collected data, second step, they are going to process. So after that, they are going to give the interpretation. So interpretation, whatever results are received, whatever results are got by the processing data, that data they are going to communicate to the top level management. The management will involve in the decision making process. So relationship with the financial and cost accounting. See, relationship with the financial and cost accounting means what? Here, simply management accounting, it is the internal focus. They are going to concentrate on internal only. But whereas financial accounting, it is going to be reporting to the external. Cost accounting, cost control and efficiency purpose, it is already I discussed that cost accounting is a subset of management accounting. It is also part of the internal focus only. So there are different differences also there. Management accounting versus financial accounting, management accounting versus cost accounting. First, I will discuss about the management accounting versus financial accounting. So what is the difference is there? Management accounting versus financial accounting. Here, yeah, the purpose of management accounting, what? The purpose of financial accounting is what? That I'm going to explain right now. Simply, this question, they are going to ask theory questions in the examination. This is a very important topic. What is the difference between management accounting and financial accounting? See, purpose first. Financial accounting provides the financial information to the external stakeholders. To providing the data, that information, financial information for the externals like shareholders, this financial accounting is going to be prepared. But whereas management accounting helps in the internal management decision making purpose. So this is the difference between financial accounting and management accounting. Users. See, financial accounting users, investors, creditors, regulators, customers, company directors. So all the people, they are going to use this data. But management accounting users are internal users only. That is managers and executives. And focus. Financial accounting focus on past oriented and focused on the financial performance only. But management accounting, they are going to focus on future oriented and focused on the planning and controlling purpose. This is the difference. Next one is the regulations. See, regulations in financial accounting, there are some standard regulation bodies are involved like GAAP, IFRS, etc. But in management accounting, there is no regulated bodies can involve. Simply, it is not regulated. It is flexible format. And the next one is the reports. That reports in financial accounting predict reports, example, income statement and balance statement, periodic reports. So we are going to prepare in the financial accounting. But in management accounting, detailed and frequent reports we are going to prepare like budget statements, cost analysis. These all are we are going to prepare. And this whatever the prepared statements are there, reports, according to financial accounting, as per Companies Act, this is the very essential and mandatory. But that whatever the frequent reports prepared by the management accounting, like budget reports and cost analysis, it is decision making purpose only, not for the act purpose. It is not mandatory also. So time period. Generally in financial accounting, we are going to cover fixed financial period, generally quarterly and annually we are going to take. But in management accounting, it covers short-term period and long-term period. Scope of financial accounting. Financial accounting focus on overall financial position and profitability purpose only. But management accounting focuses on internal operations and efficiency purpose. This is the difference between financial accounting versus management accounting. Now, I'll explain financial accounting versus cost accounting. What is the difference between cost accounting? What is the difference between financial accounting and cost accounting? See, same, whatever variables I taken previously to explain the differences between the financial accounting and management accounting. Here also same differences I am going to use for the explanation of differences between financial accounting and management account, cost accounting. Hello. Hello. Good morning. Right. Here, the key differences between the financial accounting and cost accounting. Now I will explain. Purpose. Financial accounting, already I explained that it is records, reports, financial transaction, external users only. But cost accounting, analyze the cost of production and operations for the internal management purpose only. Second one, users. Then generally users, external users, we are going to observe in the financial accounting, but cost accounting is, it is internal users, same like management accounting, managers and executives. It is focused. Financial accounting focus on the profitability and financial position of the company, and cost accounting, it is focused on the cost control and efficiency of cost reduction. And regulations. See, regulations, already I explained, it is the same management accounting and cost accounting, financial accounting, whatever we discussed with, here also same applicable. For financial accounting, there is some standardized bodies are there, like GAAP, IFRS and other accounting standards. But cost accounting, there is no bodies, not required any regulatory bodies, and not there also. Reports, financial statements, income statement, balance sheet, cash flow statements, we are going to report. But cost accounting, cost reports and budget variance analysis only we are going to report. Scope, broad over entire organization financial performance we are going to disclose. And here we are going to talk about the, it is very narrow and it is focused on the cost structure and specific department process and products. And time orientation. Past orientation only we are going to focus, and historical data, financial data we are going to use. Here future and present orientation we are going to use. Valuation of inventory at cost or market method, whichever is least that we are going to follow. Here at cost method only we are going to use. So this is the difference between financial accounting and cost accounting. Next, management accounting conventions. See, management accounting conventions, whatever we studied it in the financial accounting, same we are going to follow here also. So that conventions only we are going to follow. That is simply relevancy, consistency, and prudency, materiality. So these are all conventions we are going to follow. Same, whatever the first year, degree first year onwards, we are studying these conventions. The relevance means accounting related information we are going to take, and the accounting rules and regulations should be consistency for year to year, not not the changing of that. Prudency or convention of conservatism. That is also, we are going to anticipate the profits and only we are going to provide the losses. Materiality, whatever the actually happened, actually recorded, and that only we are going to consider here. And here accrual base we are not going to follow, actual base only we are going to follow. So that is the conventions. And tools and techniques of management accounting. What is the tools are there? What is the techniques are there? See, budget and forecasting, it is a technique. See, tools and techniques of management accounting, budgeting and forecasting, variance analysis, cost value profit analysis, break-even analysis, ratio analysis, capital budgeting technique, balance scorecard. So these all are we are going to use in the management accounting tools and techniques. First one, budgeting and forecasting. Again, this budgeting and forecasting, we have a chapter. So specially, I'm going to explain that chapter also. Here, just I will give the very brief about that budgeting and forecasting. So budgeting is it is the document which is records that expenses and incomes of the organization. So this budgeting is a record of the statements. And also we are going to estimate for the using of past data, we are going to estimate for the future. So that is budgeting. Forecasting means what? Purely future requirement purpose, we are going to estimate. So we are going to estimate the budgets and other streams. So forecasting generally, but budgeting and forecasting. See, there are different types of budgets are there. That is operating budget, financial budgets, and flexible budget, and static budget. So operating budget talks about the operation relevant like production budgets, sales budget, purchase budget, like that. Financial budget talks about the financial related, like cash budget. This cash budgets includes all the receivables and payments of the cash. Flexible budget and flexible budget for when there is a change of value based on the past information, when the change of value for change of production output, for that we are going to prepare the flexible budget. Statistic budget is a fixed budget, means certain point of production point, we are going to prepare the budget. So this is the budget. Steps for the budget preparation. First, we have to take the data from the internal management, and what we have to choose the tool for the estimation, and relevant data also we are going to calculate, and then we can going to estimate for the future. Benefits of forecasting. Generally, benefits of forecasting, it is very helpful for the management. How it is helpful? See, future is an uncertainty, and at the same time, based on the past data, past relevant recorded information, we have to estimate to meet the future demand, to meet the future expectations. We require the forecasting. So if we have forecasting based on the last year demand, we can predict this year also. As per that, we are going to produce the manufacture. We are going to produce the products. We are going to ready for situations. So this is the benefits of forecasting. Next one is the variancy analysis. Variancy analysis, generally, there are different variancy analysis are we are going to calculate, like material variancy, labor variancy, overhead variancy, sales variancy. So this again, we have different chapter, we have different separate chapter here. See, here, whatever the variance analysis there, we are going to analyze that standard variance analysis to that actual variance to estimate the future, whether it is favorable or unfavorable situations regarding the material and labor and overheads. We are going to analyze the variancy analysis. Next, CVP analysis and break-even analysis. See, in marginal costing, these CVP analysis and break-even analysis are very important techniques to calculate the marginal costing. CVP analysis talks about the impact of variable and fixed cost. CVP analysis means what? Cost value profit ratio. So it includes that marginal cost related. We are going to analyze what is the cost. Cost includes fixed cost and variable cost. And what is the value in that fixed and variable cost? What is the value of profit is there? So that analysis we are going to talk. Next one is the break-even analysis. Break-even analysis talking about the point when the revenues are equals to the cost, or the cost are equals to the revenues. The break-even point also we can tell that is the point where there is no profit, where there is no loss. So that point is called as a break-even calculation. Break-even calculation is helpful for the management. So based on this break-even point, the minimum targeted sales, their management people, they are able to know that. When they are able to know, they try to cover the cost. Generally, in a break-even point, they are going to cover the fixed cost. So that again, this break-even point and cost value point and this margin of safety also, we have a separate chapter that is marginal costing. So in next block, we are going to discuss. Next one is the margin of safety concept. Margin of safety means what? Actual whatever the excess of sales after the break-even point, so that is called as a margin of safety. Margin of safety talks about the after recovering the fixed cost, whatever amount we are going to generate, that is called as a margin of safety. And one more tool is in management accounting, ratio analysis. This ratio analysis generally we classified into different ratios like liquidity ratios, profitability ratios, efficiency ratios, and leverage ratios. These all the ratios are different. So these all the ratios, we have a separate chapter we are going to discuss again. And capital budgeting. One of the important tool in the management accounting, that is capital budgeting. So capital budgeting means what? That capital budgeting means the budget investment decisions in long-term proposals, in long-term budgets, in long-term proposals, in long-term requirement purpose, whatever the decision is involved, that is called as a capital budgeting. Capital budgeting is a process that is the organization, the amount when they are going to spend for the purpose of acquiring the long-term assets, for the purpose of expanding business and expanding productivity of the organization. So that is called as a capital budgeting techniques. This capital budgeting, whether investment in the capital budgeting, generally we are going to observe that investment process, investment technique purpose only we are going to use. So whether to invest or not, to take the decision, we are going to follow the capital budgeting. Generally, these techniques we classified into two categories, that is traditional techniques and modern techniques. Traditional techniques generally, that is payback period. Second one is the accounting rate of return. Whereas modern technique and discounting methods, net present value method, internal rate of return, and profit index. Here's only important techniques I mentioned here. Importance of investment decisions. See, this is capital budgeting technique is very important for the investment decisions. So among the alternatives of various investment decisions, which proposal is good, which proposal is better for the investment, to take the decision, we are going to use these capital budgeting techniques. Next one is the balance scorecard. See, here perspective of financials, customers, internal process, learning growth, we are going to use the variables. Benefits for the strategic management. This is not that much related. We'll discuss later. Next one is the in management accounting, one of the important techniques, tools, financial statement analysis. That income statement and balance sheet statement, cash flow statements, these all are we are going to analyze and we are going to give the reports. Next one is the marginal costing technique. This already it is discussed in the this is already discussed before that. Cost value profit ratio and break even analysis. This is the part which we are going to use in the management accounting. And standard costing also, it is the different variancy costing. This costing we are going to compare with the actual cost and we are going to find out the differences. And cost controlling techniques. So there are different cost controlling techniques are there. Traditional techniques are there, modern techniques are there. So, and activity based costing, this is separate chapter we have. And decision making techniques, make or buy decision and relevant cost analysis, opportunity cost, and emerging trends of management accounting. It is integrated with the AI and big data. So management accounting is integrated, it is going to be integrated with the AI and big data, and sustainable for the accounting and digital transformation in accounting also. And challenges of management accounting. The data accuracy issues are there. So whatever the data is there, that may be accurate or not, we don't know exactly. And rapid changes in technology. So when you are introducing one method, again, immediately it is going to be changed. And that is also one of the major problem. And adapting of the global market dynamics, that is a very big problem. And future management accounting, we are going to use the predictive analytics, we are going to start, and real-time reporting also we are going to start, and blockchain technology, blockchain accounting also we are going to start. So this is the story about the management accounting techniques and tools, which is there in the black unit 2 in black 1. Go through this.